But I want to keep this market conversation going here with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, it's always great to have you join us. I want to ask you about something that Jared had mentioned actually at the top of his conversation with us just a moment ago, which is how the bond markets have really been reacting, especially on some of the recent comments from the Fed and how they're tapering, scaling back some of that economic support in the markets. What are you anticipating going forward, at least when it comes to those bonds, especially as the Fed does start to make those moves, or at least look at making some of those moves sooner rather than later?
Well, Kristen, it's been really interesting. The bond market's taking it in stride, especially longer-term bonds, the 10-year bonds. The prospect of Fed tapering can be interpreted as actually somewhat bullish in the sense that it means that the Fed will tighten. That could slow the economy or reduce some of the froth in the economy. That's what happened last time. When the Fed tapered in 2014, yields actually fell. They ran up going into the taper, and then they came down. I do think, though, that bond yields have more room to move up. Right now, real yields after inflation are negative. Prospects for inflation are higher than they were back in 2014. So we look for 10-year yields to go up to the 2.25%, maybe even as high as 2.5% area over the next 6 to 12 months.
And what is your outlook for earnings, I'm curious, coming up? Because we've talked to a number of strategists lately, and they seem to think that we need to start raising the bar on those earnings and quick. What are your expectations?
Well, in our shop, we are still positive on earnings. We have an overweight on energy and on financials, where we see still the momentum and the rise in earnings growth there should continue to be strong. And when we look at corporate bonds, that's a very supportive factor as well for the corporate bond market, in that earnings continue to be very strong. And as the economy outperforms expectations, as demand continues to outstrip supply, we'll probably continue to see those earnings hold up here as we go forward.
All right, Kathy, I'm curious to know what you see as the inflation narrative throughout the rest of the year and perhaps even beyond into 2022. There's been a lot of it's transitory and no, it's not. Where do you stand in terms of inflation and even on those interest rates?
Well, yeah, obviously, we're in the midst of this inflation bump right now because of the pandemic-induced mismatch between supply and demand everybody knows about. We have the base effects. We have the bottlenecks in terms of supply. So we all know that we're kind of in the midst of this. And it's a bit like coming out of a war or something. You have to rebalance the economy. But as we go forward, when I look at, say, the TIPS break-even market, what it's telling me is that expectations are for inflation to go up towards a 2.5% area and then start to kind of level off and come down. And I think that's that's a reasonable scenario. I think inflation is going to be a little stickier on the way down this time than it was, say, post 2008 financial crisis, because the economy has rebounded so much more quickly, is so much more well supported by fiscal policy. It seems to me that getting back in the 1.5% region on inflation isn't as likely as landing somewhere in that 2 to 2.5% area. But for bonds, that means that you really want to have some yield above the rate of inflation. So if we're going to land at 2 to 2.5%, we should see bond yields somewhat above that, maybe 50 basis points above that longer term.
All right, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Thanks so much for joining us.